Hey, what is going on, guys? My name is Nick, and in today's video, I'm going to be sharing what to expect from stocks moving forward and if the stock sell-off could potentially get a lot worse. Obviously, the stock market just got wrecked this past week, and it certainly hasn't been a fun time for growth and tech investors, including myself. I've been seeing a lot of red in my portfolio lately as I've been averaging down on my positions, but there always seems to be a new low in this market. In fact, the Nasdaq index, which holds more than 3,000 market cap weighted stocks, with the majority being tech companies, is off to the worst start of the year since 2008. And it could potentially end up being the worst January performance in stock market history as the Nasdaq entered correction territory on Wednesday, January 19th, and is already down 14.2% from its all-time high. Now, for those who aren't aware, a correction is simply when a stock market index declines 10% or more from its all-time high, while if it continues to drop 20% or more, that would be considered a bear market. And honestly, we're only about 600 basis points away from entering a bear market since we are already down about 14%, so I don't think it's unrealistic to think that we could be in bear territory pretty soon. Even worse though is the Russell 2000 index, holding the 2,000 smallest market cap stocks in the stock market, and it is currently down 18.6% from all-time highs earlier in 2021, which is even closer to bear market territory. But in this video, I don't just want to speculate, I'm going to provide you with some very interesting historical data that could give us an indication of where the stock market might be headed over the coming weeks and months. Then I'll be highlighting some catalysts that could propel stocks a lot higher very soon. So as always, don't forget to drop a like on this video for all the research that went into it. It really does help out my channel, so I appreciate that. And if you haven't already, please consider subscribing so you don't miss any of my future uploads, so make sure to hit that bell notification icon. And with that said, let's get straight into the video. Alright, so the first thing I want to show you is a chart highlighting the performance of the Nasdaq index after every correction since 2007. In total, there have been 21 corrections in the Nasdaq index since 2007, including the one that we just entered on January 19th, but obviously that isn't displayed here since we don't know the outcome yet. So out of the past 20 corrections since 2007, we can see that 13 out of 20 times, the market produced positive returns only 1 week after entering the correction. Now, what's interesting is that we don't actually see much of an improvement beyond that for one entire month after the correction, where only 12 out of 20 times the Nasdaq produced positive returns. Or in other words, 60% of the time, the Nasdaq rebounded to produce positive returns within 1 month of entering a 10% correction from all-time highs. However, when we look further past 1 month, the results actually get quite a lot better. If we look at 3 months after a correction, the Nasdaq produced positive returns 70% of the time. Then even better, 6 months after a correction, the Nasdaq produced positive returns 80% of the time. So as we can see from this data, time is our friend when it comes to investing. The longer we wait, the more likely the market is to rebound from correction territory. Now, there was of course the exception during the financial crisis, which did extend for about 19 months, but this was an unusually long and brutal bear market due to the entire US financial system being completely wrecked. But even if we do continue to see red in the market over the next few weeks and months, you should have nothing to worry about if you're a long-term investor like me. In fact, being in a correction offers us some of the best buying opportunities that do not come around very often. Like, when was the last time you saw so many stocks on a 20% or more dip from all-time highs? Well, I believe the last time we saw deals this great was when COVID began and stocks were selling off brutally. But as we can see, the returns that investors achieved coming out of COVID were unbelievable in the year following, which were 54% for the Nasdaq index alone, never mind some of the beaten down growth stocks that flew much higher than this. So I do believe it's important to be cautious in this market and not invest too much all at once, just in case stocks continue tanking. But I also believe it's very important to be taking advantage of these dips by dollar cost averaging into profitable companies that are still doing extremely well, which many are in the tech sector. And I did just post a video showing my top 10 stocks that are on sale right now, where I think it's a great buying opportunity to get into these companies at a cheap price. So if you haven't seen it already, check that out, you won't want to miss it. Alright, but now let's switch gears and start talking about a potential upside catalyst that could bring stocks a lot higher in the coming weeks and months, and that would be earnings season. We have earnings season ramping up this next week with some of the biggest names in tech announcing revenue and EPS numbers for the year ended 2021, but they'll also be offering their guidance for 2022. In my opinion, this upcoming earnings season will be crucial for stocks, not only based on the numbers that they produced last quarter and for the year ended 2021, but based on how their guidance is going to be for 2022, because we'll be able to see how consumer demand is. Oftentimes in earnings season, companies can put out great numbers for the quarter that just ended, but if their guidance is poor, the stock can still drop tremendously. Just look at Netflix. The company reported incredible numbers, beating analyst estimates on EPS, and added over 8 million new subscribers to the platform. Yet because they missed on guidance, the stock fell over 20% in the next trading day, which was not the way we wanted to start off earnings season. And as we saw on Friday, the Nasdaq index was down another 2%, and much of that was likely due to Netflix's bad earnings. But I believe that many other companies with strong earnings could help bring us out of this rut that we're seeing in the market right now. And as for next week, we have tons of influential companies reporting earnings. Starting off with Monday, we have IBM and Logitech reporting, but nothing too exciting. Then Tuesday starts getting interesting, where we have Johnson & Johnson, American Express, and 3M reporting pre-market, while Microsoft, Capital One, and Canadian National Railway report after hours. Johnson & Johnson should give us a good indication of overall consumer demand, since the company is super well diversified across the consumer staples sector. But then I'm most excited about Microsoft, which will have a big impact on other tech stocks in the market. If Microsoft reports really good earnings, I could see many other tech stocks making big moves upward, but remember, it is heavily dependent on Microsoft's guidance for 2022. Next up on Wednesday, we have Boeing and AT&T in the morning, while Tesla, Intel, and Lending Club will be reporting after hours. So you all know I'm extremely excited about Tesla's earnings. I'm sure they will have a blowout quarter, but as for the stock price movement, it really depends on whether their new gigafactories in Austin and Berlin will begin ramping production, as they are currently behind schedule. So we should be getting a lot of details on the conference call from Tesla management, and hopefully Elon Musk is going to be on the call. And again, I'm sure Tesla will give very broad guidance by saying production growth at 50% plus over a multi-year horizon or something like that. So I really don't think we have anything to worry about poor guidance. Moving along, Thursday will be the biggest day next week, where we have MasterCard and McDonald's reporting in the morning, while the big dog Apple and Visa are reporting after hours. Apple will certainly be a market mover, since demand for iPhones and Apple products is a good overall indicator of consumer demand, so expect some price action Thursday after hours. Then I believe Visa and MasterCard's earnings will also be huge indicators of consumer spending behavior now, so if they do have good guidance, this can be really good overall for the market. Finally, on Friday, the week tames down with Chevron, Caterpillar, and Weyerhaeuser reporting pre-market. And I'm sure Chevron's going to have blowout earnings because oil's been so high lately. Overall, I think this upcoming earnings season could be a huge catalyst for either the upside or the downside, depending on how these companies guide for 2022. Another upside catalyst for stocks moving forward will be heavily dependent on bond yields. So if bond yields do continue to rise, that's obviously not a good thing for stocks, but if they do taper off and stay relatively constant, that could mean some more upside in stocks. And of course, once we get the inflation report for January, that will also be a big trigger for stocks, whether to the upside or downside, depending on the amount of inflation. And we will have to keep up with what the Fed Jerome Powell is saying about everything, so that of course will affect the markets big time. Anyways, those are my overall thoughts on the stock market right now and how earnings season could impact stocks moving forward. So next week will be very interesting. And let me know if you want me to make some follow-up videos after companies report earnings, such as Tesla, Meta, Google, or Amazon. I would be happy to do any of those companies. So if you did enjoy this video, make sure to drop a like and subscribe if you haven't already, with those bell notifications turned on. And with that said, I will see you guys after earnings next week.